Hello guys, and welcome to the trading journal from Vertical Spread for Friday the 18th of December. My name is David and I'm also known as the Spread Doctor. Today is the Quadruple Witch Friday. The Quad Witch Friday occurs on the third Friday of the month of every quarter. So the third Friday in March, third Friday in June, September and December. And the Quad Witch Friday refers to the simultaneous expiration of single stock options, single stock futures, index options, and index futures. All four of them expire on the same day, i.e. today, on the third Friday of the quarter. And one of the characteristics of the Quad Friday trading session is that it usually sees some very large volume. So very large volume is usually traded on the Quad Witch Friday, but that large volume doesn't usually see a corresponding large move in price. So there's a large volume, a lot of volume traded, but the price tends to trade in a narrow range. And if you look at the heat map, it's largely red, and most of the equity indices did close down today. However, the magnitude of the down move is quite small when you consider the volume that was traded. And also when you consider that the Dow and the S&P 500 closed at an all-time high yesterday. One might expect some profit taken, but the Quad Witch Friday usually messes things up. And at the closing bell, the Dow was down by 0.41%. The Nasdaq was down by 0.07%, and the S&P 500 was down by 0.35%. None of them was down by more than half of a percentage point. Another thing that that did increase the volume today is the rebalancing of the indices. So the S&P 500 index also gets rebalanced today, and come Monday, next Monday, the new entrants into the index will start trading as part of the S&P 500. And the major headline grabber in this regard has been Tesla. So Tesla is going to be part of the S&P 500 come Monday. And the weird thing about the price action in Tesla today is that so Tesla is up 65% over the last 5 weeks. Since November, Tesla share price has gone up by 65%. And there are many fund managers who would rather not buy Tesla at this really, really high level. But because Tesla is going to be part of the S&P 500, they are forced to buy it. So the passive index funds that track the S&P 500's performance, they had to buy Tesla today ahead of it joining the index on Monday. And that caused an explosion in the volume of Tesla shares traded today. And to put that volume in some context, Tesla usually trades an average of around 45 million shares a day. That is the 30-day average volume. Well, today Tesla traded 200 million shares. That is 4 times its average daily volume. And to put a dollar value on the Tesla shares that traded today, given where it closed, I think it closed around 695. Yeah, it closed at 695. That would equate to a value of 131 billion with a B, the value of Tesla shares that traded today. So I mean, there was an awful lot of volume going into Tesla, and even though the share price is so high, any passive fund that tracks the S&P 500 needs to include Tesla to be able to track the S&P basically. So they had to go out and buy Tesla shares. And I think the question on most people's minds, including mine, is whether Tesla will make the S&P 500 index more volatile. I believe when Tesla joins, it will be the 6th most valuable company in the S&P 500 when it joins on Monday. So a question most people are pondering on is whether S&P would become more volatile when Tesla joins, because we all know how wild Tesla trades, or whether the S&P 500 will tame the beast in Tesla and make it act like a grown-up stock. Well, I guess time will tell what happens when it joins the index, but it'll be an interesting one to watch how it responds to being part of the index. And I think historically, most companies see their share price underperform when they join the S&P 500 for the first few quarters. We'll see if that happens again with Tesla. In other news, the Fed released the results of its second bank stress test. That's a mouthful. The stress test of the banks. It did the first one, and then it did a second test, really stress testing these banks. I think this one was if there was a downturn of about, was it 600 billion or something, and then all the major banks passed the test with flying colors. And because the banks behaved themselves and passed the test, the Fed has given them the green light to resume their stock buyback program. You may recall I covered in one of my journals in the spring when the Fed ordered the banks to stop buying back their stocks, to suspend their buyback programs. These buybacks will lift the banking sector. So the banking sector has been lagging all the other sectors or the major indices, and there may be some volatility in the market as a result, and there may also be some opportunities to sell some spreads in the bank stocks, but that will be for next year. Moving on to the VIX. The VIX was down slightly today. The VIX was down about 1.64% to close at 2157, and it remains stubbornly above the 20 level, the key level. The S&P 500 hit a new all-time high yesterday, and the market is still pricing in some volatility. I mean, this is unprecedented. Usually you'd expect the VIX to be around 10, 9, 11 when the market hits an all-time high, but not this time around. Moving on to my trade ideas. I had no new trade ideas today, but I did have an adjustment to my open position in Moderna yesterday. I explained the rationale for making the adjustment in the trade idea recording, so if you missed it, you can check out the trade ideas forum, and I'll also drop a link to the recording below. The December contract expired today in the Quad Witch Friday, and there are now 27 days until the January contract expires. And that means my window for selling spreads in the January contract has now closed. Moving on to my open positions. I now have 3 open positions in the Jan 21 contract, and they are in MRNA. I'm going to call this one position, PDD and BMRN. And I'm going to review those positions. For MRNA, I'm not sure everyone managed to convert this put spread into an iron Condor by selling the call spread. So what I'm going to have to do is, excuse me, to cover the 2 positions for MRNA. So I'll cover the standalone put spread, and I'll also cover the iron Condor as another position. So starting with the put spread, MRNA put spread. So on this one, sold the 115, 110 put spread for $2. Short the 115 put. Let's see where MRNA closed today. So MRNA closed at $140 $5.23. My short 115 put is conveniently out of the money. In terms of the P&L, so if I go to my portfolio tab, I wouldn't be able to see my P&L just for the put spread because I now have 4 legs. I have an iron condor. But what I can do is go to the trade tab and find out what the mid price is and work out what the P&L should be. So sold the 110. So I sold the 110. Come on. Nope. Right, so because I have an open position in it, it wouldn't let me select it from here. So I had to do a bit of fudging around to get it into the ticket. So sold the 115 put and bought the 110 put as a hedge. The mid 118, sold it for $2. So that works out. The current P&L is positive P&L of $82 per contract on the 115-110 put spread. Moving on to... Actually, before I move on to cover the iron condor, when I converted the position to an iron condor yesterday, in the adjustment recording, I mentioned that converting the put spread to an iron condor would improve the break-even point on the trade. But I didn't go into details and explain that when I was putting on the trade, so I think I'll just do that now. So with the initial put spread, I saw the 115-110 put spread for $2. My short strike is the 115, and let me do this. So my short strike is the 115, and the position begins to lose money if MRNA falls below 115. However, the theoretical break-even point is not 115, it is below 115. So the spread is $5 wide. You get that by deducting 110 from 115. I collected a premium of $2. And my break-even point is $113. So Moderna has got to fall below 113 at expiry for this position to start losing money. So you deduct the premium received from the short strike, which is, my short strike is 115. I collected $2, deducted from 115, and you get 113. So the break-even point on the 115-110 put spread is $113. That is the point where the position starts to lose money at expiry, theoretically that is. Now the iron condor, I sold the 115-110 put and sold the 165-170 call, and I received a total credit of $3.06. With this position, I am going to have 2 break-even points because I now have 2 short strikes. So my 2 short strikes, I'm short the 115 put and I'm short the 165 call as well. And again, although the position will start to lose money if MRNA falls below 115 or if it rises above 165, those are not my break-even points. My downside break-even point is 115, which is my short strike, minus the 306 that I got in credit, and that gives me 111.94. So with the iron condor, MRNA has to go below 111.94 at expiry for this position to lose money. The upside break even is my short strike is 165 plus the premium I collected, which is 306, and that gives me 168.06. So that is the upside break even, and you can clearly see that the break even point excuse me, on the iron condor of 111.94 is better than the break even point on the put spread of 113. In other words, there is more room for the stock to fall on the iron condor position than on the put spread position. And as with most things in trading, there is always a trade-off. So although the iron condor took in more credit and it has more room to fall on the downside, it has an additional constraint of having an upside break-even point, which the put spread doesn't have. So with the iron condor, it's got an upside break-even of 168.06. Above that, the position starts to lose money. With the put spread, there is no upside break-even, so this thing can go to the moon and this position will still make money. So that's the trade-off. Moving on to my second position, which is in PDD. So on this one, I sold the 170-175 call spread for a credit of $1.35. Let's see where that position closed today, or where PDD. So PDD closed at 149.37. My short 170 call is out of the money, is conveniently out of the money, and no adjustment, no action is required on this one for now. In terms of the P&L on this one, currently showing 292.5. I have 5 contracts, so that works out as positive P&L of $59 per contract at the moment. And the third position is in BMRN. On this one, I sold the 75.70 put spread and I got a credit of $1.13. Let's see where BMRN closed out today. So BMRN, I'm short the 75 puts. The stock closed at $88 and let's call it $89. So my 75 put is currently out of the money. No action is required on this one. In terms of the P&L on this one, open P&L is $81. I only got filled on 3 contracts. I didn't get my full allocation. I wanted 5, but I got 3. And that works out as positive P&L of $27 per contract. And that takes me onto my watch list. I'm not going to go through them individually, but these are the items on my watch list today: ARKK, BMRN, JKS, EBS, and I haven't seen this stock in a while, BlackBerry. I'm going to look at this one, BB. So BB has implied volatility of 50. Wow, $6, $7. BlackBerry. So even if I wanted, even if my window for selling spreads was open and I wanted to do something, this thing is too small in value to be able to do any meaningful spread. But there you go. BlackBerry, that used to trade at $100, is now $7. And that brings me to the end of my journal for today. The main highlight is that my window for selling spreads in the January 21 contract is now closed, and the next new trade idea will be in the new year for the February 21 contract. I hope you enjoyed listening to my journal. You can leave me any questions or comments below, and have a great weekend. Thank you. Bye-bye.